Hello there, in today's video I'll be reviewing STAG Industrial. I'll go through what it does, I'll go through its finances, we'll go through its share price, I'll let you know if I'm buying it, selling it or holding it and what price for. If you're new to this channel, welcome. My name's Andy and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell and then you get notified every time I release a new video. And if you enjoy this content and find it useful, please do remember to give it a thumbs up because that helps the channel, which in turn helps me and I do really appreciate it. Now, if you've watched this channel before, you'll already know that I invest in STAG. I have shares in STAG already. I'll go through how much I paid for those at the end of the video and I'll also let you know at what price I will be looking to buy more so you know where we're heading with that. But for those of you who don't know what STAG does, I will go through key slides from their investor presentation and we'll explain that right now. So as you can see on this slide here, STAG Industrial is an owner and operator of industrial real estate. Basically, it has warehouses. You can see on the right hand side there, Amazon is one of its clients. It's actually its biggest client. I'll show you what percentage that takes up in a moment. It claims to be the only pure play industrial REIT active across the entire domestic, that means American, industrial real estate market, designed to create and enhance value. Since their IPO, which was back in 2011, this slide here shows a change, so you can see how much the square footage has increased. You can see how many properties they had in 2011, 93, versus 462 by Q3 of 2020. And a nice thing to see there is the secured debt. It was 100% at IPO and it's down to just 3.3% now in 2020. And you can also see the equity market cap as well. See how that's grown from 290 million to basically 4.6 billion. So that's quite some growth in 9 years. Operational expertise focused on maximizing cash flow. The key takeaway here, I think what they're trying to get across is that they have insight knowledge and expertise which allows them to buy properties cheaper than competitors would. Here are some examples. So multifaceted approach to creating value. So you can see when they've acquired various things there, and as it says across the bottom there, they have the ability to create value through leasing and redevelopment. This slide here really just is to get that across. Value creation through development. So this is a slide I've shown before. You can see that left-hand graph there. You can see the increase in percentage of sales going online versus regular retail sales. You can see how in 2012 it was only 5.3% and by 2020 it was up to 16.1%. And you can see that despite the big growth in 2020, it was growing anyway. So in 2019 there, it was around 11, coming up to 12% of the total sales were online at that point in time. Now then, you have to take a view on whether the 16%, this spike is going to stay there and it's going to climb from there, whether it's going to level off, whether it's maybe going to dip down a little bit, maybe it'll go back to 12% and then carry on its gradual climb and probably will overtake the 16% at some point in the future, but the odds are once shops are allowed to open again, they'll get back a lot of the market share that they'd lost. Maybe not all of it, but a bulk of it. But obviously you can see the general trend is that e-commerce is growing, and that from this company's point of view, from STAG's point of view, is a good thing because they rent warehouses which are generally used by the online retailers, which we'll see who their clients are in a moment. Broad-based opportunity set. What they're showing here is just how big the market is for industrial property and just what a small share of that STAG currently has. So they have a lot of growth potential. That's, I think, what they're trying to get across in this particular slide here. Process-driven approach to address attractive opportunity. And you can see the acquisition pipeline on the left there. So you can see they are actively growing their properties. And even in 2020, you can see there that they're actually growing their properties greater than they were planning to previously. So the pandemic, while it slowed down and stopped a lot of companies in the tracks, this is not one that really has been affected at all. In fact, if anything, it's had a positive effect on STAG. Emphasis on diversification. Portfolio spans 60 markets. It's the largest market exposure. Is less than 10% of annual base rents. That's what ABR stands for. The portfolio includes exposure to 45 plus industries. The largest tenant is less than 3% of annual base rents and less than 25% of leases expire through 2022. I would actually say, from my point of view, 2022 is not that far away. We're nearly into 2021 now. 2022 is basically 1 year away. So, you know, for me, 25% of your leases expiring in 2022 22, I wouldn't say is necessarily good, although it does say less than that. I'd love to know exactly what the figure is, but it's fair to assume it's more than 20%, or they would have said 20%. It's probably 24 point something percent, almost 25%. Of course, they're very likely to renegotiate the leases, so it's probably nothing to worry about anyway, but I just thought I'd point that out because obviously they're presenting that as a very good thing, and I don't know how good it is. I'd love to know what the breakdown of lease expiry is, because I think that'd be an interesting thing to see, but they've not shown it, so I can't tell you. Sophisticated and diverse tenant base. Now here on that bottom right there, you can see their top 10 clients. Amazon is their biggest client, making up 2.3% of their rent, which I think is great that it's such a small percentage from such a large company. As long as they keep that under 5%, personally, I'll be happy. I like good diversification when I'm investing in a REIT because it means no one single tenant can pull down the company. This is kind of one of EPR properties' weaknesses. If you've seen any of my videos about EPR properties, I'll put a link up there and down below to one of my EPR properties and more of them down below for you as well in the description. That's one of its weaknesses. This STAG does not have that weakness. It's not so exposed to any one client. So as you can see there, you've got some big names there. Amazon, General Services Administration, even the Ford Motor Company's down there on that list. It also tells you there the size of its tenants. So 55% of the tenants are publicly rated, 86% of tenants have revenue over 100 million, and 61% of tenants have revenue in excess of $1 billion, which is brilliant. And the top 20 tenants only account for 20% of the annualized base rent, which is phenomenal. So it's a really good spread. So I do see this almost like an index fund of industrial properties, if you like. They have spread themselves really well. So it's a nice spread. I see it as quite safe personally in that respect. Conservative balance sheet. I will come on to the balance sheet a little bit later, so we'll review that properly a little bit later. But you can see there how they've been improving things over time, how their EBITDA to debt coverage is improved, how their fixed charge coverage is looking, and you can see that 100% of their borrowing is fixed rate. And at that bottom right, you can see the debt ladder there, which I think is a very interesting thing. So you can see there was nothing due in 2020, nothing due in 2021, 199 million due in 2022 with interest rate of only 3.61%, and after that is when the rest becomes due. So from 2023 onwards, I would have liked to have seen those years spread out so that we could see, because for all we know that might all be due in 2023. I seriously hope that's not the case, and I'm sure it's not, but whatever the case, it's a good low interest rate that they've got it fixed at there. You can see 3.62%. This is interesting. Obviously this is from their investor presentation slide, so they are trying to sell themselves here. So they're pointing out a compelling valuation. So their FFO multiple 16.4, I'm going to look at that in a moment. They say that's versus the peer average of 29.4, and you can see at the bottom there what peers they've compared themselves to: DRE, EGP, FR, PLD, TRNO and REXR. And as well, they point out that it's low risk, and we agree with them about low risk. They've put widely diversified portfolio across geography, tenancy, industry, lease maturity, investment grade balance sheet with low leverage and high level of liquidity. That low risk thing, 100% agree with that. Brilliant. So now I'm going to show you something I found when I was researching this over on Seeking Alpha. I'll put a link down below to the actual article if you want to read the full article, but this is the crux of the article here. STAG Industrial launches new solar systems in Illinois and Massachusetts. Basically, they're renting their roofs for solar is what I could make of this. And when I looked into this further, I actually managed to find on their own website, STAG, and again, I'll put a link down below to their press release page. So if you want to go and read all the press releases on the STAG website, you can. The link will be in the description. So this is just part of that. It's just to give you an overview of it really. But basically this is a different solar system they've put in, which was in Boston this time. They've actually got 25.5 megawatts of solar nationally, and obviously they've got these big warehouses with the roofs, and that, as I understand it, is where they're putting the solar panels and then renting that off. So that's yet another stream of income, and I think solar's a definite positive for the future and a good income stream potential for them, as well as allowing them to be perceived as environmentally friendly. And there are people that will only invest in things that they think are green and whatnot, so that might help get more investment in STAG and thus help their share price increase in the future. But either way, I see it as a good move, and I'm surprised it wasn't mentioned in their investor presentation, maybe because it makes up such a small money amount, but I do think it's a nice little touch anyway, so something I thought I'd make you aware of. Before the next section, I just want to let you know that STAG Industrial actually made it into the list of a portfolio, a hypothetical portfolio that I created to make $1,000 per month. If you're interested in seeing that portfolio, I'll put a link up there to the video about that and in the description down below. It's a $1,000 per month monthly income portfolio, and STAG was one of the shares that made it into that. So if you're interested in that, take a look. Other than that, we'll just move on. So if we look at the 1 year chart here, you can see, just like everything else, there was a massive drop back in March. It then recovered very quickly, but not fully, and it's then continued up. It peaked around August time and then fell down, then went back up again for October, and then you see it's been trailing back down again since then and basically staying relatively flat, and currently standing at $30.70 per share. That will no doubt change as I click around. That's the 1 year chart. If we click to the 5 year chart, you can see there the general trend, I would say, is up. Obviously, we've got the big March dip. I mean, that was an amazing buying opportunity. Anybody buying at the bottom of this dip would have done very well indeed. There's no two ways about that. Now, you can see the price to FFO is 16.26. If you remember my video last week where we compared FRT to SPG, you remember they had a price to FFO of 10 and 20 respectively. So this is kind of priced on that metric, kind of halfway between the two. If you're interested in that previous video, I'll put a link up there and in the description down below. They're two other REITs, completely different type of REIT to this REIT, but still, if you're interested in that, use the link up there and down below and you can watch that. The dividend yield is 4.74%, which is obviously very respectable. You can see the 52-week range. It's been as low as $17.64 and as high as $33.24. Obviously that low is exceptional because of the dip back in March. Really, you would see it's rare that it dips. Well, look, where was it? A year ago, 31, 30. We have to go back 2018, 2019. It's the lowest price I can find in 2019 is at the beginning of the year, $24-ish. So that's the beginning of the year there. So it did have a drop at the beginning of 2019, end of 2018. Did the same kind of thing at the beginning of 2018. There was a drop there. 2017, it didn't do the same thing. But at the beginning of 2016, you can see it had a drop at the beginning of 2016. So it does have a bit of a habit of declining at the beginning of years. This year, obviously, nothing to do with anything else. And I couldn't tell you what the previous years were for, but that does seem to be the general trend of things. So if it follows that same trend, it may well be about to dip, and if it does, fabulous. You can see that it looks like it's been dipping, certainly since its peak there, which was approximately mid-October. You can see the general trend there has been down ever since. Now let's look at the balance sheet. So the things I like to look at on the balance sheet with a REIT, really, we want to look at the total real estate assets. You can see 2015 it had 1.5 billion, 2016 1.8 billion, 2017 2.2 billion, 2018 2.6 billion, 2019 3.5 billion, and in the current trailing 12 months 3.6 billion. So that is growing very, very nicely indeed. We like that. What we're interested now in looking at is the total assets. And again, you can see that has been climbing very nicely. It's over doubled in the last 5 years, which is absolutely phenomenal. And total liabilities is the other thing to look at there. And you can see that's gone from just over $1 billion to 1.8 billion. So that hasn't over doubled. It's gone up, but not by the same amount, which is obviously a good thing because it means that the company's equity has been improving during that period of time, which as a shareholder is something you want to see happening. So now let's take a quick look at the income statement. So let's look at the total revenues. So in 2015, total revenues 218 million, went up to 250 million in 2016, 300 million in 2017, 351 million in 2018, 406 million in 2019, and that's increased again in the current trailing 12 months to 464 million, which is over double what it was 5 years ago, which again, phenomenal growth. Bear in mind, this is a REIT we're talking about. This is really good growth. Let's take a quick look at the net income. So in 2015, it actually made a loss, and then it was 34 million, 34.5 million in fact in 2016, 31.3 million in 2017. So that was a bit shaky, up to 92 million in 2018. That fell down to 49 million in 2019. And then phenomenal, 123 million in a trailing 12 months. So that's been a bit of an up and down story. It's generally increasing though, and in view of the fact that they've been improving the balance sheet so much, I would suspect that those years where it's not looking as good on the net income side is due to expansion and buying and acquiring more assets. That's my take on that, quite honestly. So I'm not really concerned about that at all. So now let's take a look at the dividends for STAG Industrial. It's 4.74% dividend yield. You've got an annual payout of $1.44 per share per year, that is. You've got a payout ratio of 77%. Now the 5-year growth rate of 2.08%, I'm not sure if that's actually correct or not. It basically puts it up about a penny per year. Obviously it's a penny divided by 12 because it's paid monthly, which is something I should mention there. So it is a monthly dividend stock. As I mentioned earlier, it's one that made it into the $1,000 a month portfolio, but it's also one that has not cut its dividend in 2020, has not suspended its dividend in 2020, which means it made the list of stocks, of monthly dividend stocks that have not suspended their dividend in 2020. I made a video of that full list. If you're interested in it, I'll put a link to that up there and in the description down below so you can take a look at that at your leisure. Hopefully, if you're looking for monthly dividend stocks, that is a great way of finding them, ones that have not had to suspend their dividend, so ones that have fared better during the 2020 pandemic, if you like. So here's their dividend history. As you can see, they have been increasing the dividend every year all the way back to 2013. So I make that 7 years of dividend growth. This is where they paid a double dividend in the months of February and March 2018. And that resulted in a higher spike, which has then resulted in Seeking Alpha discounting their ongoing increases and counting it not as increasing. I'm overlooking that and saying that actually they have been increasing it for 7 years. But still, it is increasing and it's a monthly dividend that is growing and solid. And it's already starting at a reasonably high rate, 4.74%. So now let's look at the assets versus the liabilities. Now, if you've seen any of my versus videos, of which I've done many, I'll put a link up there to my versus playlist and in the description down below. So if you are interested in seeing other versus videos I did, but you will know that I put a lot of weight on this particular metric. It's one of the metrics that is measured in those versus videos, and it's great for a head-to-head because you can literally see at a quick glance who's got the better balance sheet. I can tell you now, these figures that we've got here for STAG are phenomenal. Had this been in a head-to-head, it would have almost certainly won. There's not many companies that are going to have better metrics than this. I assure you of that. I'm so impressed with these. So total assets, 4.2 billion. Total liabilities, 1.8 billion, which gives an asset to liabilities ratio of 2.36. That means they've got over twice as many assets as they've got liabilities, okay? And then the current assets to liabilities, that ratio there is 2.01, which is just phenomenal as well, because it means that assets and liabilities, things that are due in the next 12 months, they have that covered twice over with their current assets. That's a phenomenal boast, basically, and a great thing. So you know, we're generally looking for that number to be over 1. So to be over 2 is super, absolutely phenomenal. Let's move on to what I know you've all been waiting for. How much did I buy them for? Would I be buying more? And at what price? Let me show you that now. So here you go. I bought STAG at $26.59 per share. The current market price as the time of speaking here is $31.03 per share. My new target buy price is $28.80 per share. So if they do dip below that price, I will be buying for sure, and I'm considering a buy price under $29 per share. Now the reason for those figures, really simple, $28.80 per share at their current dividend payout rate, that would make a 5% dividend yield, and I think at 5% dividend, STAG is a really good buy, certainly better than anything you're going to get in the bank right now, that's for sure. So then you're thinking, well, why has he said $29 or under? It's because I'm expecting that in early 2021, they will increase their dividend by the equivalent of 1 penny per year, which would actually mean that to get the 5% dividend yield, I can pay anything up to $29 per share. So that's my logic there. I'd love to know if you're buying STAG, if you already invest in STAG. If so, how much should you buy in it, and how much would you be looking to pay to buy more STAG? If you've got a target buy price, please do let me know in the comments down below. I always love to hear your thoughts on these things. Other than that, thank you so much for watching. Have a nice day, and bye bye.